For today's main topic, here's how we're going to go about exploring the differences between term life insurance and whole life insurance. I found a Forbes Advisor article that I believe to be relatively neutral in its bias. We're going to take what we learned from the Forbes article and review an old clip from the Money Guy show. I really respect Brian and Bo when it comes to personal finance. After that, we're going to be considering a wonderful example from the PBS show 2 Cents. And finally, before I go into my personal plan for life insurance, I'm going to give you a resource for further investigation so you can better your understanding of life insurance. Let's jump right in. The Forbes Advisor article is called Term versus Whole Life Insurance. What's the difference? This article was updated last in December of last year, 2023. The article starts by saying life insurance policy types can be put into two main buckets: term life and cash value life insurance. One of the choices for cash value life insurance is whole life insurance. There are other cash value choices too. Knowing the main difference between term versus whole life insurance will help you zero in on the best life insurance for you. As a quick teaser, we're going to learn about a third type, which is kind of cool, but we're going to get into that a little later. Let's move on to term versus whole life insurance. There are two main differences between term and whole life insurance: premiums and cash value. First, they're going to talk about term life insurance. Term life insurance lets you lock in level premium payments for the term length, such as 20 years. Many term life insurance policies allow you to renew each after the level term ends, but renewal rates are usually very expensive. And that's because as you get older, you're much more likely to pass away from old age or disease. At some point, you'll be old enough that you cannot buy term anymore. But if you got a policy when you're really young, say 20, and it expires at 40, it'll go up by maybe about, say, 50-ish% of the premium. That it'll vary on your case, but that's a good guess from my experience. Let's continue. Term life insurance is generally the most affordable type of life insurance because you are buying purely life insurance coverage. I like that. There is no cash value within a term life insurance policy. If you decide to end a term life policy, you can simply stop paying premiums if your policy expires while you are still alive. There is generally no refund of premiums. I don't think of that as a bad thing. I mean, you paid for coverage during that time, and the cost of that coverage is the premium. Now for whole life. Whole life insurance also has fixed premiums, and you'll generally pay for the duration of the policy. A whole life policy will build up cash value at a steady, fixed rate. You can take out this money via a policy loan or withdrawal. If you decide to end the policy, you should notify the insurer so that you can get a surrender value of the policy. You see, if you have a cash value insurance policy and you want to cancel it or surrender it, the value that's been built up is due back to you. That's the surrender value of the policy. Next, we've got a little table that goes over the differences between term insurance and whole life insurance. The first one talks about level premiums versus fixed premiums. The big thing that you need to know about term is it expires in a limit. So they say it typically comes in 10, 15, 20, or 30-year terms. The fixed premium for whole life insurance lasts your whole life or when you cancel the policy. And that basically covers the next item, the fact that they expire. The next major difference is that term life is easily, and they bold it, the most affordable life insurance option. Whole life insurance, it straight up says, significantly more expensive than term life insurance. My experience says on average it's about 20 times the cost. So if you spend $10 a month on a term policy, you'd be paying $200 for the equivalent whole life policy. In the column underneath that, it says that term life has no cash value and that whole life builds cash value you can access while you're alive, most likely through a policy loan. The last two bits here, guaranteed death benefit for both. However, for the whole life policy, if you borrowed against your cash value, it can reduce your death benefit. That means if you don't pay the loan back, your death benefit is diminished. So you're taking away some of the risk that was otherwise deferred for the sake of your loved ones. Last one, there's no surrender value for a term policy, but there is a surrender value possible for a whole life policy. I'm going to gloss over the next part of the article. It basically says when you're shopping around for whole life insurance, things that impact your premium are going to be your age and gender. Whole life insurance is typically more expensive for guys because women outlive men on average. Next is going to be the amount of coverage. The more insurance you have, naturally, the more expensive it's going to be. Your current and past health. If you have major health issues or a history of family health issues, that could very well impact your premium, making your policy more expensive. Next is going to be your prescription drug history that ties into your health. And last are other factors such as your driving record or tobacco history. The next part of the article is a brilliant little table that shows you from their research the comparison between term policies and whole life policies. They compared $500,000 policies. And for the term one, they said it was going to be a 20-year term specifically. So if we look at a 30-year-old, a female is going to spend $16 a month for $500,000 in term coverage. However, for their whole life, again, for a $500,000 policy, it's going to be $352 a month. A guy at age 30 is going to be $19 a month for term and a whopping $394 for whole. That means that the whole life insurance policy is just a little bit more than 20 times the cost of the term. For 40-year-old female and male, term is going to be 24 and 28 respectively, so a little bit more expensive, but whole life insurance has gone up to $506 for a lady, $564 for a guy. I'm now going to skip past their deep dive into what term insurance is in order to look at this table, which covers the benefits and the drawbacks from using term insurance. The benefits are numerous, but there are only 3 drawbacks that are listed. Let's go over the benefits. More affordable than whole life insurance. We saw that. Premiums stay the same during level time period. That's great. That means you can budget well around this. Guaranteed death benefit amount. I certainly hope so. That's the point of the life insurance. Next, you only pay for the coverage during the time you need it, like until the mortgage is paid off. We'll dig into that a little bit more later. The last 2 benefits they have are you can often convert a term insurance policy to a permanent life insurance policy. That's true. You need a particular rider for that, and it costs a little bit more. And the last one is life insurance riders are usually available to customize a policy. I know a couple of my policies have riders on them. All right, into the drawbacks. After the level term period ends, renewal rates can be expensive. Next, there is no cash value to tap into while you're still living. Now, as much as they list this as a drawback, it's only a drawback because permanent cash value life insurance exists. If we had a health insurance policy, it's not going to be a drawback that there's no investment component to it. We still had health insurance. Lastly, if you still need life insurance after the level term period, you'll have to pay higher renewal rates or shop for a new policy. Quick aside, if you use term life insurance, you can buy policies every few years or so that your coverage is stepped up over time, and the term that they expire is sort of staged or staggered so that as they expire in small bits and pieces, not all at once. There's a similar table of pros and cons for whole life insurance, but this time there are equal benefits and drawbacks. For the benefits, fixed premiums are available for budgeting every month. You can also do paid up cash value life insurance where you put a large amount of the premiums in up front over the first few months to years and pay nothing after. The second benefit is it builds cash value at a steady rate. We don't know much about that rate yet, but we will get there. Third, has a guaranteed death benefit amount, just like term. Fourth, life insurance riders are often available, just like term. Whole life insurance policies may qualify for dividend payments depending on the company. Now for the drawbacks. Much more expensive than term insurance, for sure. The fixed rate for the cash value growth may be minimal. That's really interesting. When you get a whole life policy, there's a guaranteed minimum rate. Guaranteed, you don't see that very often in the investing industry. If you see guaranteed, it's typically tied to an insurance product like this. But that guaranteed rate is usually small, and we'll cover that too. Third, if you withdraw or borrow from cash value and don't repay it, the death benefit will be reduced. Again, you need to recognize if you want to use whole life insurance throughout your life, and that's sort of your intention, it's going to be at the expense of the risk that you're deferring. Fourth, your beneficiaries get the death benefit, not the death benefit plus the cash value, unless you have paid extra for this feature. This is a huge misconception around whole life insurance, that the cash value is building on top of the death benefit, but the death benefit typically includes the cash value. So they're only going to get the death benefit on the policy. They don't get both. Lastly, it could take many years to build cash value in a policy. Make sure to examine the policy illustration before you buy. This is what happened to Joshua back in the story. His policy was front-loaded with the fees, so the premiums he was paying, even though it was the same every month, none of what he paid went to the cash value. So when he terminated the policy, his surrender value was 0. Okay, next I want to skip ahead to the part of the article where it says how to choose between term and whole life insurance. There was a lot to this article that I skipped for brevity, so if you want to read the whole thing, it's linked in the description. Jumping in, how to choose between term and whole life insurance. When choosing between term and whole life insurance, consider your reasons for buying a policy. If you want life insurance to replace your salary for the 15 years until your youngest child leaves for college, you don't need the hefty expense of whole life insurance. Term life insurance is a much cheaper option if you need coverage for a set number of years. So what Forbes is saying is if your need for life insurance is temporary, then temporary life insurance or term life insurance is your deal. Term life insurance may be a good fit for you if you have a specific debt, such as a mortgage, that you want covered if you pass away. 2, you have children and want to make sure their college tuition is covered. Or 3, you want life insurance to cover a certain period of time, such as the number of years you have until retirement. That last one's a big deal if the bulk of your net worth is tied up in retirement investments, because you can't access that really until 59 and a half, with few exceptions. But if you're not planning on getting access to that money until then, you may need life insurance to cover your income up to that point. Jumping back in, whole life insurance may be a good fit for you if 1, you want lifelong coverage, or 2, you want to fund a life insurance trust. 3, you have a dependent who needs lifelong financial support, such as a special needs child. That's a big one. 4, you want life insurance that builds cash value you can access during your lifetime. There's a key word that's been repeated 3 times. Did you catch it? It's going to hit again here on number 5. You want to ensure there's a death benefit to provide money for your funeral expenses regardless of when you die. Okay, I want you to remember that 4 out of the 5 of these that make you a good fit for whole life insurance were wants. 1 was a want for lifelong coverage, 2 was a want, 4 was a want, and 5 was a want. The only non-want in this list from Forbes was number 3. If you have a dependent child that's special needs and will need a permanent source for their care, a permanent financial source for their care. When I was preparing for this episode and reading through that Forbes article for the first time, it reminded me of an old Money Guy clip where Bo straight up talks about having recommended a cash value policy to a client. This is going to be interesting.
All right, so here's one. This is from Mr. Robbins. I'm going to reframe his question. He said, hey, should I do whole life insurance? And if not, what should I do and when does it make sense?
It would definitely not be at the, realize when you're looking at your foundational wealth building, you're not starting with whole life. Nobody wakes up one day and goes, you know what I think I need for financial independence? Whole life. You know who says that? Life insurance salesman.
Whole life salesman.
Because they make a commission off of it. The thing is, look, life insurance in general, very, very valuable resource because it is going to protect you in case you need your income replaced to fund goals, to pay back debts, and those type of things. But it's in competition. You got to cover the risk, but you're also in competition of getting the army of dollar bills saved because you want to start saving early and often so that hopefully by the time you reach financial independence, retirement age, whatever date you've chosen for that, you've saved enough so that it works. So why would
I want to point out here that what Brian is saying is if you do a good job building wealth during your working years, your accumulation period, your need for life insurance is temporary. And I'll expand on that. It's not only because your wealth is replacing the death benefit, because if you die, you have enough money that your spouse or your dependent is going to be okay, but also because as time goes on, those who are dependent on you become less and less dependent on you, such as children growing up and moving out.
Would you go spend thousands of dollars a year on life insurance, because that's what whole life will cost you, and then not have money to go invest yourself? You'd want to do term, starting off with term so that you can then take the difference and go invest in your financial independence. So hopefully down the road, 20 years, 25 years, the life insurance goes away and you have enough resources. So when does whole life make sense?
Before we get Brian's next answer, I want to highlight that he just talked about get term and invest the difference. It's a very common counter to whole life insurance. In essence, Brian's saying, let's build a foundation where we make sure that our financial future is secured from the investing side, make sure that we're deferring risk on the life insurance side separately for their respective terms. And because a lot of what we saw for whole life insurance was once, Well, we can get that only after we've made sure that our financial investing that's done in a more conventional manner has secured our future.
In the past, it was when your estate was above the estate tax exemption because you wanted to have permanent insurance, meaning it could never go away. So that's what the whole life was going to, it had cash value that was going to build up. And it was going to be a great estate planning resource. Now that estate planning exemptions have exceeded $11 million per person, so $22 million for a couple, I'm going to let Bo tell us when we need whole life.
And this clip is a little old. That number might be outdated, but that's still a lot of money. So if you ever run into the pitch where a life insurance salesman is saying you need the whole life stuff in order to counteract the federal estate taxes, that's not going to be applicable to the vast majority of us. Now, you might say there are some states that have estate taxes, but it's not going to be near the burden that a federal estate tax would be. And also, it's really not something that you have to worry about too much unless you are worth millions and millions of dollars.
It makes you scratch your head.
Yeah, it does
doesn't
make you scratch. Now, here's what I think is interesting. You ready for this?
Yeah.
I recommended a whole life policy 1 month ago.
Okay, let me see if I can guess.
Okay.
Because here you want. Let me add one caveat. Make sure your term has the potential where it can be converted
Okay, good point.
to whole life,
Yep.
because some of them will allow that to be something. The term can be converted to whole life. Okay, I don't know. Tell me what you did.
I have a couple that I was working with, a wonderful couple, and there was a legal proceeding that took place a number of years ago. And as part of that legal proceeding, this person was required to have life insurance the remainder of his life.
Oh, that makes
Had to pay
sense.
for the-
Makes
well,
sense.
they at the time when the legal thing happened, they bought term insurance. It was great. Well, now that he's gotten a little bit older, his term is starting to expire. And if the term expires, he has to have insurance in place. So he either buy a new term that could be really expensive, or we could convert the term that he has now to whole life,
Still
or
could potentially be really expensive.
he
though.
could purchase a brand new permanent life insurance. When we looked at the cost, it actually made a lot more sense to go purchase a permanent life insurance policy so that he could guarantee level term for the rest of his life, single premium or
Level
fixed
premium the
level
whole time.
premium for the rest of his life. He has that life insurance going to pay, so he was able to satisfy that court mandated coverage, and he doesn't have to think about it anymore.
Isn't that fascinating? A court mandate basically saying you need to have life insurance for the rest of your life, basically mandating a permanent solution. I think that's very clearly an example that does not apply to the bulk of us, but it provides a good example that permanent life insurance does have a place. It does fit a need that is out there, even if it's not for the vast majority of us, to use Joshua's words. Now I want us to ask, how big of a difference can it really make in the long run when it comes to deciding between term and whole life? Whole life seems to talk a lot about the investing aspect of financial planning, while term is just purely the life insurance stuff. Well, to answer that question, I want to share an example from the PBS show 2 Cents.
Tia and Tamara are twins, both age 40 and are shopping for life insurance. Tia picks whole life while Tamara picks a 30-year term life. The death benefit for each is $500,000. Tia will be paying $563 per month for a whole life policy according to US averages. That's pretty steep, but Tia was attracted to the cash value growth. She's thinking this will count as some of her investing each year, and that 5.5% is a pretty good return.
But hold on, Tia. The 5.5% dividend only applies to your cash value portion, not the full $563 payment. According to a 2015 Consumer Reports study, after costs like commissions and fees, the average whole life investment return was closer to 2%.
That's a really interesting claim, and to come from Consumer Reports of all places, I'll share that with you after we get through the example.
Tia lives to age 70. She'll have paid $202,680 in premiums, but her policy will have a cash value worth almost $280,000. She's been insured her whole life and made money. Sounds like a win to me.
Now, Tamara's 30-year term life is costing her $52 each month. If she also lives to 70, she gets nothing back. So Tamara decides to invest the difference between her premium and what she might have paid for a whole life policy.
Get term and invest the difference.
And if she invests in a basic stock index fund, she'll probably average over 7% for the next 30 years. At 70, her life insurance will be worthless, but her investment will be worth over $600,000. That's twice as much as Tia got with her whole life policy.
Now, given the source that we're going to jump into, I don't think the returns that they used were inflation corrected at all. I believe that 7% was before inflation, which in my opinion means this example is, in a sense, generous to the whole life position. And I want us to remember that the $274,000 that Tia had in this example, well, it is her cash value, but to access it, she needs to take out a loan, which will diminish the death benefit if her need was to have a permanent life insurance policy in place. And she needed that whole $500,000 to defer some sort of risk. Now, a key part of that example from 2 cents was that the whole life policy only had a cash value growth rate on average of 2%. They said that came from this particular source, Consumer Reports. Is whole life insurance right for you? If we scroll down, there's a good bit of bulk that you could read through in this particular report. But the key takeaway that 2 cents was quoting lives here in this paragraph that reads, however, the average annual rate of return, 1.5% for a whole life guaranteed cash value. That's the guaranteed, was 1.5%. 2.2% for treasuries and 3.5% for the whole life possible cash value is undercut by inflation, currently about 2.2% per year. Now, it's important to note that this was written back in 2015. So inflation numbers have completely changed. But where did they get 2%? They averaged 1.5% for the guaranteed minimum and 3.5 for the possible, basically going right between. I don't think Consumer Reports actually said that the average was 2%, but that it's likely 2% or about 2%. And really, 2 cents is probably close to correct on their interpretation, given the fact that it has to fall in that range in the source. But this is an old source. Is there something newer that we can look at? And indeed, there is. This is a very long article, and I'm just going to blow through here and show you how incredibly long it is. So I'm not going to read through all of it. I'm not going to cover near all of it. I'm going to point out the big highlights that mattered to me. Now, even though this is a really long article, this is a comprehensive deep dive for the differences between go with term and invest the difference and choosing a whole life or cash value policy. It does come from the bias of do term and invest the difference, but it covers almost every argument for whole life. And I recommend that you give it a read if you wanted to learn more about this topic. I'll link it below. Now, the White Coat Investor primarily caters to an audience of doctors, but all the same, the contents of this article can be applicable to all of us. I want to start here by looking at myth number 2. Whole life is the best way to get a permanent death benefit. Remember in the Money Guy clip, they talked about a unique case where someone had to have life insurance for the rest of their life. If we look at myth number 2 on this article, whole life insurance is the best way to get a permanent death benefit. Go to the middle of the first paragraph and it talks about something called guaranteed no-lapse universal life insurance. What is that? Well, according to the White Coat Investor, it does not accumulate any cash value, but simply provides a lifelong death benefit. So it's like a term policy, but the term is your life and there's no cash value. It only costs half as much as whole life. So this would still probably cost around 10 times what a term policy would, but it would last your whole life. I wouldn't be surprised if Bo from the Money Guy show recommended a product like this, for a client who's mandated to always have life insurance. But let's not forget why we jumped over here in the Consumer Reports source. It was old, 2015. This here is only 2 years old. This is from 2022. In method number 3, whole life insurance provides a great investment return. You see that the White Coat Investor recently analyzed a policy for a 30-year-old male with a 53-year life expectancy. And he found, just like in the Consumer Reports article, that the guaranteed minimum growth of the cash value was less than 2% after 5 decades. The next paragraph even continues to say, even if you use an insurance company's optimistic projected value, you're still looking at a return of less than 5%. In reality, you'll probably end up with a return of 3 to 4. When I've done comparisons for cash value life insurances, similar to the one from the PBS show, I've used typically 3.2 to 3.5 to be optimistic in favor of the whole life policy. Lastly, under myth number 36, there's a really interesting statistic that you should know. I'm going to paraphrase a little bit, but according to the White Coat Investor, 80% of whole life policies are surrendered before death. 80%. And 76% of the doctors that he surveyed regret their purchase of whole life policies. I guess you could say 3 out of 4 doctors believe that whole life insurance is a regrettable decision. As we close out, I want to reiterate that this article from the White Coat Investor is good continued reading if you want to learn more. Throughout the whole of it, you're going to find that he believes that whole life insurance satisfies a lot of wants, a lot of bells and whistles that the salesmen like to talk about, but not a whole lot of needs for the vast majority of us. And it may go without saying, but this is what I'm doing for my life insurance plan. Given the financial goals that Amanda and I have, given the plan that we're working in place, the HopeFilled Financial Footsteps, it doesn't make sense for us to go through the extra cost for a cash value life insurance policy. All of our investment work for retirement, all of our tax sheltered investment that we want to do can be accommodated through traditional account means without looking into a whole life policy at all. And when it comes to deferring risk for one of us passing away early, well, that need is temporary. I don't think our kids are going to stay at home forever. I don't think I plan on working forever. I think we're going to build up enough wealth at some point that we can consider ourselves self-insured on this front. So I sincerely believe that the most frugal decision for us is to buy term. And I'm not even investing the difference between it and a whole life policy. It's important to recognize that buy term and invest the difference. Very rarely are you going to go and actually invest the difference. You should, though, be looking at your retirement plan, your investing plan, your wealth building plan, and say, how much do I need to be investing to make my plan a reality? Begin your plan with the end in mind and work backwards from that to figure out what steps you need to be implementing today and make sure you understand your investing strategy moving forward. We're going to talk about that later this year, so subscribe if you don't want to miss it. With that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.